Hello everyone, my name is David Roberts and I'm a portfolio manager working as part of the Palomar fixed income team. We launched our first in-house boutique with Nedgroup earlier this year, having started to set it up in 2024, and this represents the first quarterly update since the fund was launched. So just thinking about the market then, we thought we'd start with a quick snapshot of what's happened in bond land over the course of the first quarter. Generally, economic data was significantly better than most people had forecast, and that meant that the expectation for central bank action was pushed back significantly. Across the G7, as many as 7 interest rate cuts had been penciled in from, amongst others, the Federal Reserve. That reduction in expectation for rate cuts in 2024 meant a small rise in sovereign yields. And by the end of the quarter, the market was forecasting round about the same number of cuts as central banks had anticipated. The gap had narrowed but not completely closed. Risk assets from equity to corporate bonds continued to surge, generally led by anything AI related. If we think about performance, then over the course of the quarter, central banks' expectations were rolled back, but as I said, yields actually didn't move that much. For those who have looked at Alex and I's comments over the course of the past year or so, prior to launch and after launch of the portfolio, you'll see that we talked about the old normal, which really means that we expect interest rates to be much more sticky, to move much less than many in the market had expected. Now, most investors, I would say ourselves included, do believe that we will see some rate cuts in 2024, just not as many as the market had been expecting. So this slight change of expectation did create a little bit of volatility, rates moving up, rates moving down, credit spreads moving tighter and slightly wider, and that gave us an opportunity to add a little bit of value, as we'll see shortly. Corporate debt, as I say, really over the quarter remained largely unfazed, supported as we saw money moving into all forms of risk assets. Relative to the underlying index, we remained overweight, but our quality bias is significant. And in addition to that, we have a shorter maturity profile in the corporate bond sector. And as we'll see, what that does in combination is give us a nice level of income relative to the market, but also gives us a degree of volatility protection. As you can see from the table, it was a nice start to the portfolio, and we finished both positive in terms of total return, which is always nice, and pleasingly ahead of index. If you look at our prospectus, you'll see that our investment target is to return around 1.5% gross of fees on an annualized basis. So if you take that run rate, which is reported net, you'd see that since inception, our run rate is significantly above the target rate. If we look at some of those drivers of performance, then they've actually been quite widespread. Most people tend to think about fixed income as having very few levers to pull. But one of the good things about a truly global strategic fund is that there are many sources, both of, I would say, beta, so market direction, and then also alpha, so what additional performance can we add without worrying too much about market direction. And I guess most people would think that it's really all about duration management, so how much interest rate risk you take. But of the 40-odd basis points that we returned through the quarter, really only 5 or 6 of those came from pure interest rate management. As I say, over the quarter, yields were actually little changed, and some of that small amount of gain actually represents what I would call almost short-term trading, so taking advantage of the volatility within the market rather than changing our strategic stance. We also did quite nicely from the move in the interest rate curve, which during the quarter started off flattening, so long-dated bonds performing better than short-dated ones, and then reversing that as we moved through the quarter. Geography, though, and asset allocation were quite important. As I mentioned earlier, we were ahead. We had a higher weighting to credit than the index, but also our geographic spread was very nice. So we continue today to have a similar geographic exposure, which favours Europe versus the US and Japan, three of the major components of the core part of the bond market that we look at. With Japan abandoning yield curve control, again, that added to our portfolio, and we were a heavily underweight index, and indeed in absolute terms, had a small short in Japanese bonds. But lastly, one of the major contributors to performance was credit selection. And Alex and Matt, who worked with me on the portfolio, did very well to avoid any of the credit disasters through the course of the quarter. Many people may not be familiar with names like Altice and Thames Water, but Altice is one of the biggest European telecoms companies. It's just a conglomerate, junk bond rated, and one that really we've had some concerns about for years. And that did drive down index and also some performance too. But at the same time, we gained from some of the higher beta names in the portfolio, and those are listed on the slide. If we move on a little bit then, and I start to consider a little bit more in terms of positioning. Again, I've mentioned a couple of times that we had a high weighting to corporate debt, so 70% is a little bit above what we would normally expect to have. But as is normal with fixed income, you really have to think about the quality, the maturity, the beta of that exposure. And although the overall number was quite high, actually the beta, the market risk was lower than we would expect through the fund to hold through the course of the cycle. Part of the reason for that is because we continue to believe that most parts of the credit market, certainly anything lower than BB, to be highly expensive. So 70% in credit, but over 60% of that was investment grade, and almost everything in the portfolio was BB rated or better. As I said, yields did increase slightly during the period, although after quarter end, thanks to some of the data we've seen from the US, yields have actually risen quite significantly. But as of quarter end, we had increased the duration, the interest rate sensitivity of the portfolio, to about 5 years. Still significantly less than index, because our view is that until markets understand there is a possibility interest rates are not cut this year, then it's appropriate to have a defensive interest rate position. As I say, yields did move a little bit higher, and that's when we took advantage to add that duration. We didn't really care too much. There was a general move in interest rates towards higher levels, really led by the US, but we did add in the US, the UK, and in Germany. Again, this is actually a start of Q2 comment, but what we did see following strong US inflation data at the beginning of the second quarter was very poor performance, surprisingly perhaps, from Japan, and that led us to close down the small position that we had. So if we move on again and just have a little bit of a look at the detail around that positioning. So the first thing, again, sovereign bonds, about a third of the portfolio, yielding just over 4%, which again, relative to the last 10 years, is quite a high level of yield. And the duration of those bonds is slightly longer than the overall portfolio. So again, you get this idea that although we are taking quite a lot of corporate bond risk, it does tend to be shorter maturity, and we're looking at the sovereign market to balance our interest rate risk. It's just slightly towards the lower end of the expected fund range. And again, the big part of that and the reason that we're light against the index is because we did expect what we have seen as April has unfolded, a significant sell-off in government bonds. So underweight against the index and a slightly lower than average holding for our portfolio. And as I mentioned a minute or two ago, at time of this recording, we remain overweight European assets, which have been performing very, very strongly relative to the rest of the world. We think about credit. So again, we've got a decent weighting to the investment grade part of the market. But if you contrast the duration number, both for investment grade and high yield, you will see they are significantly lower than our portfolio and what we had just seen on the sovereign slide. So quite defensive. I should also say that that high yield weighting is composed of anything that we deem to be a higher beta bond. So subordinated financial, even if it has a higher rating than junk, we would include in that basket. So the pure exposure to lower quality credit, as I say, is slightly below that level. Again, with investment grade, we're slightly towards the upper end of our limit. Bear in mind again, higher quality, shorter maturity, etc. We think that investment grade relative to high yield offers better risk-adjusted returns for clients. In terms of the overall index, now we are showing the pure investment grade weighting to the Bloomberg Global Aggregate Index. But the index is roughly 50-50 split between pure sovereigns and other things. Those other things including agency debt, etc. So we've tried to be as pure as possible in this reporting, but in essence we are not as overweight the investment grade part of the market relative to the index as keeping it pure would suggest. In terms of credit positioning, as I say, we think the market remains quite expensive, certainly the riskier end of the market, and indeed long-dated securities, which is why we're in higher quality and shorter maturity. Economic fundamentals, as I mentioned at the beginning, have been improving, and that generally favours credit. But we, at the moment, believe that valuations continue to be too expensive despite those good fundamentals. We have also seen a significant amount of supply into the market, but that has been met with extremely strong demand. And it's really only if we start to see a general rollover of risk assets, perhaps as a result of geopolitical issues rather than economic ones, that we would likely see a reduction in that ongoing strong demand. A big source of demand has been money starting to come out of money market funds. So the huge amount of weight that's gone into cash funds over the past few years is just starting to reverse slightly. And generally, one of the first places that tends to go is funds such as ours, and in particular into the corporate bond section of the market. So we'll see if that continues. Now that yields have reached a level, bond yields have reached a level we haven't seen for a number of years. So if we move on again, and just think about the top 10 holdings. So again, there's a global strategic fund where we are slightly nervous about the direction of interest rates in particular. So what you would see there is the top two holdings are US sovereign bonds, where effectively short maturities, where what we're doing again is trying to protect the portfolio against short-term volatility in the market. One of the things with the way that we look at our portfolio is that the higher the quality the asset, generally the larger the weighting that we'll have. And as you can see there, the top 5 or 6 holdings are all in sovereign land. If we move down to holdings 7 to 10, then we start to move into corporate bond arena. And you can see from those weightings, significantly lower weightings than we have in the sovereign world. And in terms of a portfolio, a 2% weighting in corporate bond is a big position from our perspective. In the case of all of these securities, they're high quality, well within the investment grade part of the market. And if you look at the maturity dates on the right-hand side of the slide, then again, you will see that they are all shorter maturities, nothing beyond 10 years. In fact, just to put the portfolio into perspective, there are no holdings in the portfolio which have a maturity longer than 10 years. In part, in fact, in large part, that's because we just see no value, simply increasing risk if we were to lend longer either to corporates or indeed to governments, given that there is effectively we are receiving as much to lend for 5 years as we would to lend for 30. So the portfolio, high quality, bias towards short end of the market because we don't see a huge amount of value in chasing risk just at the moment. And if we move on again, these are just some of the names that you would have seen coming through in the portfolio. Again, the portfolio is very much focused on high quality G10 to G20, we would say, as represented by the government bonds that we invest in. And certainly on the right-hand side of the chart, there are quite a large number of companies that I'm sure everyone who is watching this video is familiar with. But that's really a theme that plays through our portfolio style and strategy. We tend to focus on the higher quality, more liquid part of the market, allowing in the small team that we have to be as nimble as we can be in the market and to exploit opportunities that we identify. Rather than necessarily having to wait for sign-offs from investment committees or perhaps dabble in some of the darker, less liquid corners of the market. So again, I think that's quite a good representative slide for what you're likely to see in the portfolio, or indeed do see in the portfolio today. Let me just move on and have a quick look at market outlook. So I did say that we were recording this video at the beginning, was actually closer to the middle of April. And since quarter end, what we have seen is strong data from the US in particular continuing, particularly with respect to employment and inflation. That has seen yields in sovereign bonds rise significantly, and we believe that the market now better reflects central bank thinking. Risk assets don't really seem to care that much that funding costs have increased. And again, we're in a world that's still being led by the so-called Magnificent Seven, where rates of growth are so huge, or projected rates of growth rather, are so huge that they don't really need to care whether the funding costs are 2% or 5 or 6%. And we see that reflected in dispersion in terms of the equity market. I would guess you probably best call them traditional, perhaps value type entities have tended to lag, clearly because the cost of debt, the cost of funding to them is more important than to those perhaps still less encumbered. Having said all that, we do think that we're now in a situation where current yields offer significant protection against further capital loss. There are people predicting that US bond yields, so core treasuries, could end the year around 5%. But obviously for anyone buying at today's levels, where treasuries are already above 4.5, then that gives you a high degree of total return protection against a further sell-off. So being underweight or short fixed income carries an increasing total return risk. And that's something I think people really need to bear in mind. We do expect, now again, geopolitics aside, we do expect rates markets to start to calm down a little bit, in part because it is more expensive to short the market, as we said. And current levels, I think, are increasingly appealing to a broad range of buyers. We were making the case previously that really market levels were a little bit at risk, but still suited long-term buyers. Where we are today, I believe, gives an increasing opportunity in the short term to capture some money for our clients. Credit does remain too expensive, so it's unlikely that we'll change our overall stance. So we'll retain quite a high weighting, but maintain very defensive positioning within that weighting. So really, although there are many risks around, none of which is our central case, it's not a sensible thing to do to chase credit risk at this stage in the cycle for our investors, given the low level of excess return. And then just, I guess, the last point, if we are surprised, and that's one of the nice things about, say, a nimble process, if we are surprised by something, particularly, I would say, a geopolitical event, which changes the outlook for the market radically, then from where we're positioned at the moment, we do have significant opportunity within the portfolio to take advantage either of a rally or indeed of a sell-off.